Welcome to Smart Project Concepts. We finally made it. What I call Smart Project Concepts is this is a university grade education in Forex. What you're going to see, there's going to be a bunch of webinars, a bunch of videos down below. All these videos, they are recorded in a virtual class setting. It's like I'm here in the classroom and you're on the other end watching how we present things, present simple concepts on the whiteboard in a virtual class setting. Now, I know a lot of you members are older members of Market Fluidity and you're just getting into Smart Project Concepts watching this. There's nothing new. Some concepts are newer, but some concepts are even more broken down for a better understanding. For people who are new, I welcome you all to the best education in Forex when it comes towards simplicity. As new traders, there are a couple of things that happen, right? Psychologically, things go wrong. Mentally, things go wrong. You go into over trading, over risking. But once you truly understand what price is really doing, where market is really moving, how candles are really printing, all these things go away, which is why there are a couple things that we really focus on a lot in Market Fluidity and now coming into Smart Project Concepts. All these things, they go hand in hand, and technically, if you really truly understand how price is moving, why is it moving, when there's volume, when there's not volume, psychologically, your whole perception about trading gets better. So, take it slow. There's a lot of information. There's a lot of knowledge in this section and the Market Fluidity section. So what I'm going to say is if you are new, if you've maybe been in the Forex market for about a month or 2 months, I would highly recommend following these concepts slowly and gradually, building a trading plan, refining your trading plan, and you're going to see a light at the end. This has happened to a lot of people. This is still happening to a lot of people, and a lot of new people are going to see that light, are going to see that light of profitability. That's what I call it, right? It's going to happen. So if you think it's not happening for you now, you just got to dial down on your risk, on your trading plan, on the time that you're going to trade, how you're going to focus and all that stuff. So it's game time. Good luck and take care. What's up, everyone? Welcome to another episode of Smart Project Concepts. Now, today we're going to talk about impulse entries. Now, before we get into the impulse entries and the candle confirmations and all that stuff, let me talk to you about how basically this whole idea of impulse entries came in, right? So now, in the beginning, we're basically told that you have to wait for candles to close, you have to wait for candle confirmations, whether it's outside of a zone or when it's creating a support, you have to wait for a candle to close. Once the candle closes, that's your confirmation. Then take a buy or take a sell, and price is most likely to go up or most likely to go down. We all know there are probabilities, right? There's a probability price is going to move up. There's a probability price is going to move down. Now, when we're looking at these things, right? When we're waiting for candles to close, whether bullish or bearish, sometimes price doesn't really give us that confirmation. Sometimes, price just continues rallying up or it continues dropping down. That happens a lot of times, and as a new trader, when we look at that, we think, oh, okay, maybe I'm missing the move right here. Maybe, maybe my strategy is wrong, or maybe I haven't aligned myself properly with the market because I was told to wait for the candle to close. And as I'm waiting for the candle to close, price is just moving where I wanted it to go. Man, I've missed a trade. Now, that used to happen to me a lot. And what I decided to do at that point was I was like, okay, that's interesting because I'm really good at executing when candles are closing. I'm really good at executing, especially with confidence as candle is closing. But what am I going to do when candle just continues moving my way? Because someone's taking that trade. Someone is in that trade profiting as price is moving, right? Whether that may be a entry before price moved, or maybe that was an entry that someone was, okay, you know what, I think price is going to go up and I'm just going to take a buy, and price goes up and price goes in their favor, and they're like, okay, you know what, yeah, I knew price was going to go up. But as traders, we need to execute with confirmations, right? So then I started to do was I was like, okay, you know what, if price goes in my favor without candle closing, how could I have executed on this trade? Now, sometimes, we can use a buy stop or a sell stop. Well, buy stops and sell stops basically mean is that once your buy stop is executed, you're anticipating price to continue moving bullish. If your sell stop is executed, you're anticipating price to continue moving bearish. Now, when impulse entries came in, so you have to look at where price is breaking the highs or the lows, because I decided that, okay, you know what, if I'm missing out a trade and price continues moving, where could I have an entry? And I spent almost 5 to 6 months just watching not trading, just watching. I spent 5 to 6 months just watching to see how could I have executed on that trade. And then there were like almost certain, very few scenarios that made sense. That, okay, maybe this is what we can do. So we're going to talk about, first we're going to talk about candles. We're going to talk about candles, the way the candles are closing and forming, types of candles. And then we're going to move into these certain scenarios that have personally worked best for me. And a lot of you guys, you've been through the market fluidity. We have 3 webinars on impulse entry in market fluidity. Impulse entry is 1.0, 2.0, and 3.0. You guys know that, right? But today, we're going to talk about specific scenarios that have a higher probability for price to continue where we expect it to go. So we're going to talk about that. Now, first, we need to talk about types of candles and how the candles close. Some of you may already know this, but we're going to talk about the candles once again, the whole thing, how candles close, how candles open, what they mean with wicks and without wicks. So let's take a look at this right here together. So here we have a bullish candle with no wick on the top, but it has a wick at the bottom. Next, we have a bullish candle with no wick at the bottom, but it has a wick on the top. Now, what does this mean? Usually when you have a bullish candle with no wick on the top, this means that there's no range for the next candle to go up. That's what that means. But when you have a candle with no wick at the bottom, this means that the candle closed bullish, but it had no volume to go down. It had no opportunity to even create a bearish wick. The volume was so much bullish that it couldn't even go down. It just moved up and it created a wick on the top. Right? That's what this means. This right here, the candle volume was bullish, obviously. It went up, but it has no wick on the top, which means there's no range for price to continue moving up. That's what this means. Now, if we look at this from a bearish perspective, let's say now we have a bearish candle. Now the things have turned, right? Now when we take a look at the first bearish candle, the first bearish candle means that there was no bullish volume. There was zero bullish volume. The price couldn't even make a top wick, and price came down, made a lower wick at this point. Next one, we have a bearish candle, but no wick at the bottom. This also means that there was a lot of volume for price to go down, but it didn't make a range. If it didn't make a range to the downside of a bearish candle, this means there's a 50-50 probability that price is going to continue pushing down, right? Get it? We talked about the bearish candles and we talked about the bullish candles, candles having no wick on the top and candle having a wick on the top and the bottom at the same time. So now we're going to talk about the scenario that I execute on and a lot of other successful traders have executed on to make profound gains from the market, right? So now, let's talk about that. For example, we have a bullish candle that goes up. Let's say we have an uptrend. We have another bullish candle that goes up. We have an uptrend. And then we have a bearish candle that closes like this with a big wick at the bottom, right? This normally means that price tried to go down, but it couldn't maintain its volume down. It closed a small bearish candle. This is what this means. Whenever we have a structure like this, there's a very high probability, provided there's volume in the market, that could be in your pre-London, London Open, pre-New York, New York Open, London close. Whenever there's volume in the market, there's a very high probability that price will break the high to continue pushing up. Right? Now, there are 2 scenarios in this situation, right? The first scenario, we're going to talk about the first one. The first scenario is that when the new candle starts, right, and it starts to break the high of this bearish candle, once it starts to break the high right here, there's a very high probability it's going to continue pushing up, right? Now, in this case, your stop losses are going to be below the previous candle wick. And I'm going to tell you why. The reason why your stop loss is going to be below this previous candle is because this candle didn't make a lower wick to continue moving up. It didn't make a lower wick. to continue to move up. So whenever you're taking an impulse entry with a candle that hasn't made a lower wick, there's a higher probability it can continue pushing back down, right? It has a higher probability it can retrace and come down. So this is risky at this point. So when we talk about, okay, what's the probability of this candle continuing up versus you have a candle that made a lower wick first before going up. The candle that made a lower wick first has a higher probability it's going to continue moving to the top side. But if you have a candle that did not make a lower wick and start to go up, that has a lower probability to go up. It can still go up, but the probability of going up is a little bit lower. So when I take a look at a pattern like this, or when I take a look at, if the candles are closing in this way, when you have a bearish candle, I look at the wick to the bottom as having, let's say, a 90% chance that price is going to continue to push up. But if I see that a candle has no wick at the bottom and it starts to break this high right here, I see that as maybe like a 70% chance that price is going to continue to push up. You see what I'm saying? So whenever you have a candle with a lower wick first, as it starts to break the high, I'm using my regular lot size. But if there's no lower wick, I'm using a smaller risk, a smaller lot size, because of the probability that it's going to go up, right? So you're keeping in mind the probability, you're keeping in mind the risk that, okay, what's the probability it's going to go up? And if there's a high probability, you're using your regular risk. If there's a lower probability, you're using a lower risk at that point. Now, let's talk about how are you anticipating the candles to form? Now, the basics of trends is that price, let's say you have a candle, and trend is going bullish. You have a next candle, trend is going bullish. So a normal trend is that a candle is going to respect the low and it's going to break the high. So it's going to make a higher high and it's going to make a higher low. Right? Very simple. That's the basics of a trend. So let's say if we are expecting price in this example to continue to push up. And let's say we have the perfect scenario. And trust me, man, these perfect scenarios, they always happen. They do happen and people execute on these. Now, the perfect scenario is whenever you have a candle forming, even though this candle starts to go up, it shouldn't break the high of the previous candle. If it doesn't break the high of the previous candle and it starts to make a lower wick respecting this low, and once it starts to break the high of this bearish candle, then you can say, okay, you know what? This is a very high probability that price can continue to push up. Because number one, trend is bullish, right? Number two reason is because the previous candle is an exhaustion candle. An exhaustion candle is when the wick is bigger than the body. It's an exhaustion candle. And number three is that when the candle, new one, is breaking the high. Once it's breaking the high, you're like, okay, you know what? This is perfect. All what I'm going to do is I'm going to take a sell impulse entry and my stops are going to be below this current candle. And then price is going to continue pushing up. There's a 90% probability that this will continue to move up. I've executed on this a lot of times. Every time this happens, I'm like, okay, you know what? This is a higher probability for price to move, and let's execute on this. Now, second, right? Second is basically the opposite. Let's say you have a bearish candle coming down, you have another bearish candle that comes down, so we're making lower lows and lower highs, and then all of a sudden you have a candle that closes bullish like this. Now essentially we've created a support in the scenario where a candle has closed bullish, and you're like, okay, you know what, we've created a support, and maybe, oh, one thing I forgot to mention, these scenarios, they perfectly work on the 30-minute to 15-minute time frames, right? Also, they work on the 1 hour time frame. They also work on the 4-hour time frame. But as you go higher up in time frames, what you're going to realize is that the stop losses are going to get bigger, but the moves are also going to be bigger, right? It's more prominent on the 30-minute. I've executed a lot of times on the 30-minute, very, very prominent. I've executed on the 1-hour time frames as well, very, very prominent. Now, let's say you have a situation like this, right? You have a potential support formed, and let's say this is a 30-minute time frame, excuse the writing, 30-minute time frame, and you have a candle closing like this. Now, normally, when I look at this, I'm thinking about that, okay, you know what? As long as the new candle respects this high at this point, and once it breaks this low, okay. Now, back to business, right? So now let's say if the new candle, it respects this high, but once it starts to break this low, this is going to be the perfect confirmation for price to continue pushing down, right? And in this scenario, it's going to be the same exact thing. Now, what you want the new candle to move up, but to respect this high. And as it starts to break the low of the previous candle, which is a bullish candle, this means the trend is being respected because we're making a lower high and we have an opportunity for price to create a lower low, right? So when it starts to break the low, this goes in a sell mode and then price continues to push down. This is the perfect opportunity for an impulse entry in this scenario as well. Now, important thing. When are we expecting this to happen? Normally, whenever you have a scenario like this of an impulse entry, normally with a higher probability, you're looking at the second half of the candle to break this low. Second half of the candle. Sometimes the first half of the candle also works. So let's say if you're looking at, let's say this is a 30-minute time frame, maybe in the second 15-minute candle starts to break this low. Right? So now I want you guys to follow me here, right? I want you guys to really follow me here and really understand. Because let's say the next candle, it starts to make a top wick. This means that maybe the first 15-minute candle of this 30-minute time frame starts to make the top wick. Or maybe it closes bullish, or maybe starts to go up. But as long as this high respected and the second 15-minute candle is high respected and the second 15-minute candle of the 30-minute starts to break the low, then you're like, okay, you know what? There's a high probability to continue down because maybe that second half of the 30-minute may push the entire 30-minute candle all the way down, right? Or all the way bullish if we're looking at from a bullish perspective. This is the scenario that have worked over and over and over and over again. But the trick is to actually wait for this candle to form. The trick is to wait to see if the candle is really forming like, once the candle forms like this, the next waiting situation is that you have to wait for the next candle to break the low at this point. This is something that has worked. Now, we're going to talk about another scenario, and that scenario is going to be a little bit more risky. It's risky in terms of, because the trend is already bearish and the trend is already bullish, and you're really trying to catch that wave, right? What it looks like is like this. Let's say you have a bullish candle formed like this, and you have another bullish candle formed like this, and for example, we have a resistance at this point, and now all of a sudden, we have something bearish form, candles forming bearish, and then we're also forming some sort of a confusing candle, and then we have a candle that's starting to break the high of this previous candle. Now, this is where some risk comes in. For this opportunity to continue pushing up based on an impulse entry, it has a lower probability than the examples we talked about earlier. Okay? You have to understand this. This has a lower probability. Even though you want to say that, so now this is where a lot of moves are missed, right? A lot of times you're waiting for the candle to close because, that's the safest way. But essentially what you see is that candle starts to move up and it just continues to move up. And when it continues to move up, you're like, oh man, Why didn't I enter impulse entry? It would have been so perfect. Now I've missed this entire move. It has gone up. There's no way to, like, get this back, and yada, 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 yada. That's very normal. That happens, right? So now, if you're somebody who gets stuck in these and you're not focusing on impulse entries, you're not trying to learn them, you're not trying to anticipate them, but you're missing trades, that's perfect. Because once the candle starts to break these highs here and here, you're looking at this and saying that, okay, you know what? If we broke above these highs, maybe, just maybe, I could have had an entry right over here as it broke this high right here. And my stop loss could have been below this candle. Because if we're breaking above this high, right, we're making a higher high at this point. There's a very high probability we're making a higher high. And at the same time, if we're making a higher high, then there's a higher probability we're also making a lower high, like a higher low at this point. Now, when does normally this happens? Normally this happens in high volume times, right? High volume times, market opens, market closes, we have news, we have breaking news on gold. We saw earlier on that price went up on gold about $30. 300 pips gold went up yesterday. This was the 7th November, so this may be recorded late. Anyway, whatever, right? So this is where you're trying to just watch to see where you could have entered. Now, again, as I said, this is riskier than the previous ones. This is way riskier. And I'm going to tell you the risk associated with this, right? Now, I know some people also have some questions, so we're going to go over those questions as well. Now, the risk associated with this is that even though if it's moving up, even though if it's breaking the highs right here, there's a very high probability it can just continue to fall back in this range, right? And this move up just becomes a candle that made a wick to the top hand side. That's the risk associated with this. So if you're someone who's willing to execute on something like this, you have to keep this risk in mind. If I'm going to execute on something like this, or if I'm going to execute on an opportunity which is presenting itself like this as it's breaking the high, and I'm trying to take a buy at this point, I'm keeping in mind that it can continue back in the range. So if the probability of it moving up higher is lower than the example we talked about in the beginning, I'm not using my full risk. I'm using half risk, or I'm using 3/4 risk, but I'm never using my full risk at this point. Never. At the same time, a more risky situation in this case could also be when you have a candle that just moves up without making a lower wick. A candle moves up without making a lower wick, that is extremely risky, because a regular anatomy of a candle is that a bullish candle is going to look like this. It's going to have a wick at the bottom, it's going to have a wick at the top. This is like something like a human with 2 arms and 2 legs. If a human has 1 arm and 2 legs, or like 1 leg and 2 arms, or no arms and no legs at all, then you're looking like, that's abnormal. That's, that's a bad example, but still, you know what I'm saying. So a candle here, if it has no wick at the bottom and it starts to push up here with volume, there's a chance that it can just continue to push down to probably make a lower wick. Who knows? It can continue to move down to make a lower wick. We don't know that. So once a candle moves up with no lower wick in the beginning, I'm staying out of it. I'm staying out of it because I want nothing to do with that. That's risky. That's not according to my plan. I'm not doing anything with that. Now, normally, what I would wait for, let's say you have a candle that closes bullish, right? Now, the size of this candle matters. The size of this candle matters. Let's say the size of this candle is, I'd say like 15 pips, right? Let's say the size of this candle is 15 pips. Then I'm going to be waiting for the next candle to probably make a lower wick. If the next candle makes a lower wick and starts to break the high, I'm going to be willing to take an impulse entry for candle to possibly continue up. And you all know where the stop is going to be, right? The stop is going to be below this current candle that breaks the high. That's what I'm really looking for. If the size of this candle is like 15 pips. Like you have to gauge the size basically. But if, for example, right, and I've seen a lot of people make this mistake here as well. Let's say, for example, okay, let me just make this a little bit better. Let's say, for example, that the next candle is a big candle like this, right? And now the size of this candle becomes like, 30 pips, right? This is the size, it's 30 pips. It has a wick on the top. A lot of guys are going to do is they're going to say, okay, like, you know what? If the next candle, it makes a lower wick and breaks the high right over here, I'm going to take a buy, impost entry, because Raja thought this and Raja says this and this. No. You're forgetting the fundamental rule of market structure. And the fundamental rule of market structure is that whenever we're breaking a zone, the further away price moves from a zone, the higher the probability for price to retrace. Okay? We have to keep in mind. So whenever we have a bigger candle forming outside of a zone, don't try to take a buy right here. It may go up. It may go up. If it goes up once, goes up twice, now you're going to believe that, okay, like, you know what, it's going to always go up. And that one time, if it doesn't go up, and instead of going up, it starts to, like, let's say it goes up, breaks the high, you take a buy, and it starts to go down, you're like, oh man, impulse entries are so tough, they don't work. They don't work because of the fundamental rule that the price has left the zone. Once price leaves the zone, there's a higher probability for it to come down for a possible retest. And this retest, we've talked about in market structure as well. So you have to wait for a retest. So whenever you have a big candle forming outside of a zone, and you haven't taken an impulse entry here, you're waiting for price to come down, do a retest, and then continue to push up. Now, this is where I start anticipating the first example to happen. Remember we talked about the first example? This is where I start anticipating the first example to happen. Let's say the next candle goes down, but it closes bearish like this. Now we all know what we're expecting. We all know the higher probability of the next candle. We all know how the next candle is going to form. Next candle, there's a higher probability to break this high and continue to move up, and that's your impulse entry right there. So whenever you have a candle that breaks outside of a zone and goes to a lot of pips, just wait for this scenario. That's all what you got to do. Wait for this. Wait for something to print that you understand. Wait for something to print that you can look and say, okay, you know what? I understand this. I've seen this before, and I can execute on this with confidence. Right? That's what you're waiting for. Another thing. Now, all these things that we're talking about from a bullish perspective, and it's 100% accurate if price is forming a bearish structure for a bearish perspective as well. It's 100% the same thing right here. Now, if let's say we have a wick here to the left hand side, right? We have a wick here to the left hand side, and you have the perfect candle that's forming, and that candle, like, it has made a lower wick, and you're like, okay, you know what? We've made a lower wick, and once this candle starts to break the high of this candle, you're like, oh yeah, you know what? I'm going to take an impulse entry, and once I take an impulse entry, price is going to go up. I want to make pips, blah, 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 blah. No. What you're missing is that previously, this candle here was also bullish. It was also bullish, but for some reason, it got rejected. It got rejected and it came back in the range. So as this candle is breaking the high of the previous candle, there's a very high probability that it can move up, right? That it can move up, reject it, and make a wick like this. There's a very high probability that can happen. So you have to keep that in mind, right? What a better scenario would be for you to wait for a candle to close like this, to close in this area. What this will tell you is that previously we tried to break above this area, but we couldn't. The candle exhausted, went down in the range, rejected. But now we have this Robocop candle. I'm calling it a Robocop because something's strong, right? We're calling it a Robocop candle was so strong that it closed outside of that range. So when we closed outside of that range, and this is like, 15 pips, not that big of a candle, and the next candle wicks down and breaks above this high, there's a high probability we're going to go up. That's all what I'm looking at in this scenario for impulse entries. Okay, so these examples, now watch over this virtual class again. You have to go over this again, and always keep specific, very specific formations in your mind. And they do happen, and when they happen and you execute on them, it's a beautiful thing. Trust me, it's a very, very, very beautiful thing. So, always understand this, right? Impulse entries, the first time, you're not going to get them. The hardest thing about impulse entries is fearing of you missing the trade. Even if you miss the trade, that's totally fine. You don't have to chase the trade. You don't have to be in a trade just because you've opened up a chart and you got to be in a trade. No, you don't have to, because trading is a learning process, and impulse entries are extremely hard, right? Extremely hard. They're harder because you got to wait. They're harder because you have to wait for the candle to close. They're hard because you actually have to wait to see if the pattern is forming the thing that you recognize. Once you recognize a certain pattern that's printing on the charts, you're like, okay, automatically and naturally you're going to say, okay, you know what? I've seen this before, and I'm going to execute on this. And once you execute on this and you win the trade, you look on Instagram or Twitter or YouTube, and someone else took the same trade who you idolize or look up to, you're like, oh man, you know what? This is so easy. This is so easy. But impulse entries, they always start from you just sitting and watching, right? Sit and watch price play out. It slowly comes with experience, slowly comes with anticipation, and the more you anticipate certain things to happen, I promise you, the better you're going to get at that. Now, we have again I mentioned, we have 3 other sections in market fluidity about impulse entries, but this right here, what we discussed, was the perfect scenarios that I want to see, and different scenarios that we've seen in the market. Now, some scenarios have a higher probability than the other ones. So normally, always adjust your risk. Always make sure the amount of risk you're going to take. Always make sure that the setup or the kind of formation that you're executing on, it aligns with your risk management, right? So now, I would prefer for you to go over this class again, maybe 2 or 3 times, make notes and understand what you really want to see in the markets. Take care.